Hello, my name is Sandra Newman, President and Founder of REAP Financial Group. I want to take a few moments and educate you about annuities. Now, I know that I'm stepping into a minefield whenever we talk about annuities because there's so much bad press about annuities. You read in the newspaper, you hear people on the radio, on television, many financial experts that just say, stay away from annuities. There's nothing good about them. You don't want to even consider having annuities in your portfolio. What I have found is that most of the time when you're hearing people that are talking about annuities, they're describing one type of annuity, but they don't really differentiate and explain that there are three distinct types of annuities. So the one type of annuity that they're describing, I couldn't agree more. I would say, yes, run for the hills. If anyone tries to sell you or present to you a variable annuity, you really don't want to have anything to do with that. I've looked at hundreds of them, literally hundreds of them, and I've never found one once that I would want to own or that I would recommend to a client. What I want to talk to you about are the three types of annuities. So do me a favor for the next few minutes and just be open-minded. Forget everything that you think you know about annuities, and let me just give you a little Annuity 101 and just educate you about the three distinct types. Okay, the first one I want to talk to you about is the variable annuity. Now, this is the bad boy. This is the one that gets all the bad press. Unfortunately, it is the most common of annuities. The banks are selling annuities, stockbrokers are selling them, they have very high commissions, and they have a lot of problems. And I am a big one to say I couldn't agree more with the press that you read. Stay away from the variable annuity. The disadvantages are that they're complicated. They have a lot of moving parts, a lot of gotchas that most people don't even know the questions to ask to get to the bottom of it. They do expose you to stock market risk. Many people right now, my clients, the clients we serve, are typically retired or they are retirement minded, and they're looking to reduce their risk. They're looking to reduce their exposure to the stock market. So a variable annuity, actually it's called variable because the rate is variable. It's based on the performance of the stock market. So it's exposed to stock market risk. This is not clearly understood by most people that own these type of annuities. They force you to take a payout. Many times they have a guarantee that they offer. No matter what the stock market does, they have a guarantee. Well, there's a big gotcha with that guarantee. Most people don't understand it. I don't want to really get into the details of that now, but I want you to understand that it is exposed to stock market risk. The money that is yours to walk away with is going to be whatever that stock market account has done. And then I guess the biggest complaint that I hear and that I agree with variable annuities are the hidden fees. I'm a big proponent in transparency with fees. I think everybody deserves to know what they're paying. Variable annuities have many hidden fees, and most of the time you'll never know what you're paying. If you just look at your statement, never have it on there. If you call the company, you talk to the stockbroker, they'll maybe disclose one or two of the fees, but people don't even know the questions to ask. It would not be unusual for me to see a variable annuity that has fees up to 4 to 5%. Now you think about that. In a $100,000 annuity, you're talking about $5,000 a year that you're paying in fees. And most of the time I've seen these annuities, you're paying the fees and the policyholder has not even made $5,000. So the company's making more money than the policyholder. Something's wrong with that picture. That's a variable annuity. So let me talk to you now about the other two types that are very different than a variable annuity. The second one I want to talk to you about is called an immediate annuity. Now, an immediate annuity, the way you know whether it's an immediate annuity is that it pays an immediate income. So you turn over a lump sum of cash to an insurance company. By the way, all annuities are offered and administered by insurance companies. So this lump sum then that you turn over to the insurance company then is replaced with an income that comes to you for the rest of your life. It can be over one life, it can be over a joint life, over two lives. So you turn over the cash, they promise you a payment for the rest of your life. Now, if you have a pension with a company that you've worked for, or perhaps you've worked for the state or the city, the federal government, and you are one of those rare people that still have a pension, then you have an immediate annuity. It's just not called immediate annuity, but basically you're promised an income stream for the rest of your life. Now, a lot of people like that. It provides a lot of security. You know that no matter what, you are going to have that income for the rest of your life. So it helps with not ever really running out of money to have that immediate income. I like that. I like that for my clients that don't have pensions. I like the fact that those guaranteed streams of income, very important so that we don't outlive our money. Now, the one problem with an immediate annuity that needs to also be talked about is the fact that it's permanent. Once you turn over that lump sum to the insurance company, you can't ever get that lump sum back. That principal is gone. It's replaced with an income that you can't outlive. Now, they're set up a couple of different ways. The old-fashioned type are set up so that if you die in 2-3 years or less, your beneficiaries don't get that lump sum as a death benefit. You take that income stream. When your life is over, it stops. The newer ones are set up so that there is somewhat of a death benefit. Maybe not the whole amount, but some of the death benefit. So those are a little bit different. That's called an immediate annuity. Right now, I'm not recommending those as much because interest rates are very low in this climate, and so the rate of payout is very low. I'm a little concerned about inflation protection with those immediate annuities. But as part of a good balanced portfolio, it could make sense for some people. Now, the third type of annuity that I want to talk to you about today is called a fixed annuity. Now, a fixed annuity is very similar to a CD, a certificate of deposit at the bank. Think about it. A CD is called a time deposit. So you're giving your money to the bank to hold in a certificate of deposit for a period of time. You're agreeing that you're not going to touch that money. You're going to leave it with the bank for anywhere from 3 months to 5 years to I talked to a gentleman today that bought a 10-year CD. So there's always going to be a time commitment with a certificate of deposit. That's very much how a fixed annuity works. It's a time deposit with an insurance company. So you're going to give the insurance company your cash, and then they are going to hold that. They're going to give you a rate of return that's contractual, rate of return guaranteed for a specific time. And it can be anywhere. I've seen them as short as 4 years all the way up to 15 years for a fixed annuity. Okay, a fixed annuity is like a CD. It has a few little differences. One of them is that it's tax deferred. This can be very advantageous to someone who's doing some tax planning. Tax deferred does not mean tax free. It simply means that you do not pay the taxes until you withdraw the funds. Tax deferred. So that's one advantage of a fixed annuity. There are newer varieties of fixed annuities. There's one rider that has been recently developed that has been attached to a fixed annuity. It's called a guaranteed income rider. Now, I like this rider. I like the fact that it will provide an income that's guaranteed for lifetime for one person or one person and a spouse. The guaranteed income rider was developed 5-6 years ago, I think specifically for us baby boomers, because many of us don't have pensions and we're concerned about income planning. So this gives us a way that we can know that we have a guaranteed income stream for life. Now, let me just give you an example. I think that speaks louder than me talking about it. This is an example of a fixed annuity with a guaranteed income rider. This particular example shows $100,000 being deposited. It's with a 55-year-old, and with this particular annuity, it has a 9% bonus. Now, the bonus is something that they give as an incentive. I call it the toaster. I don't know if you're old enough to remember when you go to the bank and open a CD, sometimes they give you a toaster, okay? So that bonus is like the toaster. It's like an incentive. It's a 9% bonus, which is nice. Now, I'm basing this example on a real annuity. It's an A-rated company that is available today. Now, I don't know when you're viewing this video. It may or may not be available. The rates may change, but typically there is going to be some type of bonus. So you'll just have to check with your advisor or call our office office if you'd like, and we can give you the current rates. But at this time, this is a real annuity that's offered by a real company. So it has a 9% bonus, which means now that you have $109,000 when you start that annuity. Now, it's guaranteed to grow at 7%. That 7% compound interest for 10 years, guaranteed. So now our 55-year-old is 67 years old, full retirement age. So that money has been compounding for 12 years. So 12 years later, now that annuity is worth $245,000. So now our 55-year-old is full retirement, ready to retire, get the gold watch, ready for the income stream. They want to start drawing some income out of that annuity. So based on their age and based on the amount that is accumulated in that annuity, the $245,000, the insurance company is contractually guaranteeing that they're going to receive $12,000 for the rest of their life. Okay? Now that's not a bad deal. Look at this with me. You put $100,000 in, 12 years later, you're guaranteed 12% on that money for the rest of your life. So for part of your portfolio, I would never recommend putting all your money in something like this because there is some limited liquidity. With this particular annuity, you can draw 10% out a year for the full 10 years. So it's not all locked up like a CD. You still can draw some out. There's some limited liquidity. But by and large, it provides the income stream for the rest of their life. So I like that. For some of you that don't have a pension, it might be something to look at. Okay, folks, so there you have it. Hopefully you've learned a little something that you didn't know about annuities. I would invite you to come to one of our financial seminars if you'd like to learn a little bit more, maybe some of the other things that we offer. Thank you for listening, and I hope to meet you real soon.